Welcome back to this year's federal budget wrap-up video. Alan, how was your night last night?
It was pretty quick and boring for me.
Definitely a quick and boring budget. So, as usual, we're wrapping up all of the things that are actually relevant and practical to businesses, including those with self-managed super funds as well. So, on that note, let's start with super.
Well, this will be nice and quick. There was three main announcements, or three big things to take out of last night's budget. The first one, which is affecting everyone, so not just those with self-managed super funds, is that the government's moving to get employers to pay super more frequently and be more transparent with super. And one of the announcements they made last night was that from the 1st of July 2026, every time you pay an employee, you'll actually also have to start paying their superannuation as well. So it's going to have a big impact on businesses' cash flow and how they plan out paying people's wages. But thankfully, we've got until the 1st of July 2026 for that to start happening.
And hopefully some significant changes to the way in which this is processed and a lot of issues they'll need to resolve. But nonetheless, it's something that all businesses will need to actually start to get used to and certainly start to cash flow plan for the future as well.
Absolutely. The other big thing is, and I'm hoping it's not part of a plan where they start creeping this balance down over time, but the government's also announced that people with superannuation balances over $3 million will actually start having their earnings taxed at 30% instead of 15%. So basically taxing the rich, and as I said, hopefully that means they're not going to drop that balance down over time. But importantly for our self-managed super fund clients, that's per member. So if there's a husband and wife in a fund, which most of our clients are, then you have $6 million in super before that's a problem for you.
Thankfully.
And just another thing to note around super is in the 2023 year, we're still in that temporary reduction of pension requirements. So we'll be communicating that with our clients over the next few weeks. But from the 1st of July, that temporary reduction is being removed and people's pension minimums will go back to their normal amounts.
So literally nothing realistically about super at all, except for people with massive balances are going to have to pay a lot more tax.
That's right. I'm done. That's it. I suppose we should actually also talk about something that wasn't actually mentioned last night, but was a big deal for individuals. And there was the next round of proposed tax cuts that had been talked about in the last two budget nights. Crickets on that last night. But after some deep diving and lots of coffee, what's the news around that, Steph?
At the moment, the tax cuts that are about to start 1st of July 2024, so not this year, next year, they are still proposed to actually be going ahead. And look, Labor said it wasn't their actual tax cuts, which is why they didn't actually put it in the budget last night. And because it's already legislated at the moment until next year, and they might try and make some changes, but at the moment, those tax cuts go ahead. So just as a reminder, at the moment, we kind of have 5 brackets where, you don't pay anything if you earn up to $18,000, so there's no tax on that. Then you pay 19% between 18 and 45. It's then 32.5% between 45 and 120, 37 between 120 and 180, and lastly 45 for above 180. So those changes are going to simplify things. The first two will be exactly the same, so all the way up to 45,000, exactly the same tax, because those cuts came in 2 years ago.
Yep.
What's happening now is between 45 and 200,000 will be a flat 30 cents, and then above 200,000 will be 45%. So a much simpler way of looking at things, and we're very hopeful that nothing changes and this actually goes through.
So being a Labor budget, we're obviously talking about the working class and And families generally, I think Labor generally cover them pretty well. What changes were announced around paid parental leave?
So this wasn't actually new. So this was announced last year. Paid parental leave from the 1st of July 2023 is going to 20 weeks. It's currently 18 weeks, but is kind of split between what the mum and the dad can do. This has been combined so that both parents can take 20 weeks in total, and you can choose how you actually want to take it, which means if dad wants to take 10, mum wants to take 10, that will be available, and you'll basically pick what suits your family dynamic, which is fantastic. And we're adding another 2 weeks every year. So in another 12 months, that'll go to 22, and then it'll go to 24, and capping out at 26 weeks in total when we get to 1st of July 2026. So that announcement was already made in last year's budget, but obviously bringing forward to start now, so it is important to note. Something else that is probably important to note for individuals that has been in the media, but again, no budget attention last night, was help debts. A lot of people don't realise that help debts, HECS for those people that are old like us.
Makes more sense now, HECS.
There's no interest payable on those help or HECS debts, but they're indexed each year. And because the indexation has been so high, that 7% that is going to increase on the 1st of June, not 1st of July, but 1st of June this year. So when you log into your, ATO portal or your MyGov, you'll see on the 1st of July that that actual help debt will increase by 7%. It is worth noting if you do have a large debt and you do have good personal circumstances, which means you can pay it out, it might be worthwhile having a look at that so you don't get that indexation. But again, a lot of media hype around this, and everyone's personal circumstances are completely different. So please don't just take what someone at the pub says to do and actually think about and get advice on your own circumstances.
What, you don't get good advice at the pub, Steph?
Not often.
Okay, let's bring it back to what we talk about mainly with our clients, and that's the information around small businesses. What was your take on the actual business announcements last night?
Well, there was absolutely nothing in reality for small businesses. We like to stay up to date with all the news, and so we've read all of the news articles, and I was reading a Smart Company article on the 13 things that are good for small businesses, and honestly, I thought to myself, these poor journalists have just had to make up this entire article and piece. So temporary full expensing, commonly known as the instant asset write-off, is actually finishing on the 30th of June this year, right? So what happens now is if you go and buy a piece of equipment or machinery, whatever you spend on that equipment and machinery, you can claim as a tax deduction upfront, 100% write-off right now. On the 1st of July, we were hoping that was going to be extended. It's not. It's changing so that if you have revenue of less than 10 million, you'll be able to deduct anything that's 20 grand or less upfront, and everything else will need to go into the normalised depreciation system like it used to. So for small businesses, that means that you can claim 15% of the asset in year one and 30% ongoing if you want to put it into a pool, or you have to claim it based on the effective life of the asset. So that might mean that if an asset's going to last you 10 years, you claim the deduction over 10 years rather than upfront. Still the same amount of deduction, you're just not getting that claim right now. So it'll be important to make sure cash flow pending. If you have things that you want to purchase greater than $20,000, we need to get those purchased and ready for use before the 30th of June. Otherwise, we'll be into the new rules for the next year.
And then we've also got this movement generally in the economy about being clean and green. And there was a bit of an announcement last night around what the government's doing to support businesses moving into that as well.
A little bit of announcement, but no detail. So this is falling under the small business energy incentive. And this is not a grant. It's very important. It is just an extra tax deduction. So again, effectively, anyone with a turnover less than 50 million for assets purchased between 1 July 2023 and 30 June, so not today, you've still got to wait till the 1st of July, you're going to get an additional 20% tax deduction capped at $100,000 worth of spend, i.e. $20,000 extra tax deduction. If you purchase assets and equipment basically that are going to save on energy bills. So it's effectively the electrification of assets and the improvement of energy efficiency. Think about things like energy efficient fridges, demand management assets in terms of batteries, and things that support heating and cooling systems. Important to note, this is not going to be capital works. This is not going to be electric vehicles. It's not going to be renewable electricity generation, okay? So those things are quite important to note, but we have no detail around this at all, right? So we don't actually know what this is going to look like. We'll come back to you as normal once we do, but at the moment, no actual details. The other thing to note is we had the energy efficiency grants, which was a $25,000 grant that was announced by the government in March. Round one of that literally was finished in the space of a minute. It was basically everyone had gotten in and done what they needed to do, and the round was finished. We do expect round 2 and 3 and 4, which was what originally was announced, to continue, but we don't have a date for that yet. So lots of talk, no detail.
Watch this space, I think. I think it's good overall, though, in terms of people that are obviously trying to be more energy efficient. We like efficiency here as well. Just getting the detail on it so we can advise you properly around it. Anything else for small businesses around taxes or?
Well, again, some media hype about apparently cash flow savings for small businesses.
What?
There are no cash flow savings. So the media is the pay-as-you-go instalment has actually halved in terms of the amount of GDP increase that they're doing. So what happens if you make profit in a year in your business? You need to pay quarterly tax instalments each time you do your BAS effectively, and that tax that you pay goes towards your end of year tax liability and obviously reduces what you have to pay at the end of the year. So each year that's increased by GDP. That was supposed to be 12% increase this year. We've now seen a reduction that it's only going to be a 6% increase.
Yay.
But in reality, if you're doing the right thing and you're matching your tax instalments using, say, the income tax rate, and you're doing that on a quarterly basis, it's going to make no difference. And even if you were using the ATO prescribed rate, all it does is give you those credits for the end of the year. So sure, it might be a little bit of cash saving in each quarter, but it doesn't help overall whatsoever.
Awesome. And there's some other measures too that we'll announce in our blog too, I think, about changes to tax for people that won't really be affected in our client base, but things around multinational tax and changes around that space as well. But we'll keep you posted on that in our blog. What about the general feel from the budget around spending in general and trying to support industries and where the money's actually being spent?
Well, there was a lot of headline news about the spending in general that's actually happening. One of those things that's previously announced was the National Reconstruction Fund, where $15 billion has been earmarked for that. But if you look at the budget papers, there was actually only $61.4 million announced to support the establishment and operation of it. So again, we've got all of these large, sensational, might I add, spending that's supposed to be coming, but again, we don't have the detail around that, and what has been allocated in the budget is actually less than what the overall announcement has been. The other thing to note is the industry growth programs. There's been a lot about the old entrepreneurs program and how it really wasn't living up to its supposed standards. So this has been renamed into the industry growth program. There has been $392 million earmarked for it. It's designed to support small, medium businesses, startups and the like to commercialise ideas and effectively grow their operations. So it's targeted towards the priority areas, renewables, medical science, transport, everything that's for the National Reconstruction Fund. So from that standpoint, great again, but we have no detail. So watch this space.
Okay. So Overall, though, I think that pretty much covers most of what was announced last night. As we said, it was a pretty skint budget, particularly for small businesses and superannuation. But good news is at least it's headed back towards a surplus.
It is $4 billion surplus, so that is a good news. And you're right, there just wasn't really any meat or anything that changes what small businesses are going to do in the next short period of time anyway. So all we can do is hope that there's broader reform coming in future budgets. It's not a bad thing that, nothing is changing because it is the status quo, but it would be fantastic to get an insight into what the government's actual reform looks like for the future and where they want this spending to go, because at the moment we can start tax planning today for the year as there really aren't any changes at all.
That's it. So I suppose where to from here? We're going to be sending out a blog for those people on our mailing list, and for our clients, we'll be in touch with you over the next couple of weeks to sort out the end of year planning and make sure we're taking advantage of all of those things that have been announced and are already announced, so that you'll best plan for the next year.
Fantastic.
Thanks for watching.